And for the first time in a long time, the market showed some vulnerability this past week. Investors expressing concern over higher interest rates and the Fed announcing it does see inflation on the horizon. Are the concerns about the market and the economy overblown? Joining me right now to talk more about what this week saw and what we are going to see ahead, Chase chief economist Anthony Chan is my special guest. Anthony, good to see you.
Good to be here.
A couple of things to talk about. We had good numbers on jobs on Friday, 200,000 new jobs added to the economy in the month of January. Interestingly, the wage number up 2.9% year over year. And then the Atlanta Federal Reserve saying they are going to see GDP for the first quarter of 5.4%. You haven't heard a 5% number in a while. Your thoughts?
I think it's great, but you got to keep in mind, Maria, that a lot of that is going to be because of inventory accumulation. So that's not going to be a number that's going to stick around for the other 3 quarters. But it nonetheless is very impressive, and it does suggest with that big jump that you're going to get much faster growth in 2018 than you got last year, when the average growth rate for the year was just 2.3%. We are now looking at a number that's going to get very close to 3% for 2019.
So we got a
2018.
Good growth numbers, good earnings numbers. I want to get your take on that. But that's why the market sold off this week, because interest rates move up. We saw 2.8% on the 10-year. And we also saw worries about wages going up, inflation. Was the sell-off justified?
Well, Maria, it's kind of ironic because for many years, the market has been really disappointed that workers are not getting their fair share. And now all of a sudden you see 1 month where average hourly earnings rise by 0.3% and 2.9% year over year, and there's panic. Well, the reality is that 1 month doesn't make a trend. And remember that Janet Yellen and Jay Powell is not going to be that much different, have said time and time again that they want to see wage growth on a year-over-year basis somewhere between 3 and 4%. Even with the 2.9% on a year-over-year basis, we're still far away from that. And we have a lot of things out there in the economy that suggest that wage pressures should continue to remain muted. For example, we know that academic studies now show that because of the concentration of labor market power, that companies are getting bigger, that average hourly earnings gains will be much more muted, especially given the fact that we've seen the degree of unionization come down. So it'll be a while before we get to 3 to 4%.
I think you make a really good point, because there was some argument that the reason we're seeing wages where we are up 2.9% year over year is partly because minimum wages are going up. It's not necessarily the result of companies raising wages that in a sustainable way, but you had 18 states raise the minimum wage.
That's right. The increase in minimum wages does get factored, unlike the worker bonuses that everybody's been touting. And by the way, they've been great. You've gotten almost $3 billion worth of worker bonuses.
And that's not in these numbers.
And that's not in these numbers, which means that workers are getting even more than the 2.9% because those bonuses are not computed in the average hourly earnings.
So talk to me about these markets, because you saw a sell-off, triple-digit sell-off a couple of times this past week. Look, valuations, I know we've gained $8 trillion since the election a year and a half ago. How do you see valuations?
Well, when you look at, say, the U.S. S&P 500, and you look at the forward earnings, price-earnings ratio, about 18.5 historically over the last 25 years.
Not that bad, Anthony.
You have an average of 16. But given the fact that unemployment is low and inflation is low, the so-called misery index, if you look at historically where this misery index is today, price-earnings ratio should be about 20, not 18.5. So from that perspective, I don't think we're overvalued. But when you look at that 25-year average, some investors raise some eyebrows. The good news, Maria, is that if you look at European stocks or you look at Japanese stocks, those price-earnings ratios are much, much lower than the U.S. So opportunity to diversify globally is there.
You make a great point, because for the first time in a long time, we're actually seeing global synchronized growth. Across the world, we're seeing Japan look at growth. We're seeing Europe with a 2.5% growth expectation. That has lifted oil prices. So I want to get your take on oil and the energy space. I spoke with the CEO of Marathon Petroleum, Gary Heminger. He made an interesting prediction. Listen to this.
I think that we're eventually going to see oil get into the $70, probably not over 75, but I would expect it to get into $70 and plateau for some time.
Wow, $75 a barrel oil. Anthony, what does that tell us?
Well, 2 things. First of all, you can get to those levels because you're seeing OPEC cutting the supply. But here's the exciting part, and that is that research that we've done at J.P. Morgan finds that whenever global economic demand goes up by 1%, guess what? The demand for oil globally goes up by even more, 1.5%. So, and historically, when the price of oil is rising because global economic growth is picking up, That's not a negative. That's not something that we should be worried about. We should always be worried about if economic growth is slowing and oil prices are rising, that's going to serve as a further depressant to economic growth. But given this kind of scenario where oil prices are rising for the right reasons, I'm not worried.
What are you telling clients right now? Sort of connect the dots for us from all of these economic signals, whether it's the job growth in the month of January or the expectations for the first quarter in terms of GDP growth or the earnings season that we've been seeing. You're expecting 18 to 20% earnings growth for the S&P 500 in 18, yes?
That's correct.
That's a big number.
Yes, partly because of the tax reform package. So what we're telling clients is we see very small probability of a recession in 2018. And in fact, some of that could even spill over into 2019. And with the global equity prices even being cheaper than U.S., great opportunity to diversify globally. We're telling clients to remain invested because this is a great time.
So you want to look at these declines that we're seeing and buy on the dip?
Yes, we are definitely suggesting that you buy in the dip in this kind of an environment because the economic fundamentals are not deteriorating. They're actually getting better. And by the way, if consumers get a little bit more, guess what they're going to do? They're going to spend that money. And the last point, if you look at since 2008, and you see the increase in household net worth that the Federal Reserve has talked about, has increased by $45 trillion. Historically, consumers spend about 3.5% of their increases in wealth. They've only increased their spending by about 1%. There's still a lot of pent-up consumer demand, which will mean even higher corporate profits moving forward.
So they're going to spend more money. It's all a circle. I mean, it's all a cycle.
Of life.
But you do think the job growth gains will slow. I mean, as you're talking about a larger economy, it's going to be hard to show the kinds of numbers we've seen.
Absolutely. We just got the benchmark revisions, and the benchmark revisions suggest that for 2017, we had about 2.2 million jobs being created. That's the slowest in almost 7 years. But guess what? That's not bad news. That's actually showing you that this economic expansion will turn 9 in June of 2009. And as that happens, you're going to see job creation getting a little bit more challenging. But nonetheless, we're still creating jobs. It's great news.
It's really great news. Anthony, thanks so much for your insights.
Pleasure.
Always a pleasure to talk with you. Anthony Chan, Chase economist there.